Okay, so key players in the market. You gotta recognize who you're up against and who and why they do what they do, okay? So the first individual, the big one, are gonna be central banks. Now, central bank is basically the ones that control all monetary policy, right? They're worldwide, they're all over the place. I think there's 7 of them in the United States, 7 or 8 of them, somewhere in that range. This is Ben Bernanke. When he comes out, he dictates interest rates and all that stuff. He kind of sets precedents for how all the other banks are going to play with each other. Now that affects everything, right? Interest rates affect how goods and services are coming in from the United States and they're leaving the U.S. and who's in control of this and why they're in control of that and if they're in control of all of these different moving parts. That's going to be their biggest role. Now they don't care about the stock market per se. They care about it from a fear perspective, but if GE goes up and they hit their earnings, it doesn't make any difference to them, right? They care more about stability within the market. You're seeing a lot of these quantitative easing programs, the QE 9 that we're on, I think now, wherever we are, QE3 is where we're at. But they have these things where they're influencing capital into the market to create stability, right? So that's going to be something that you need to be aware of, right? Because they really are the ones that are propping up the stock market. They're the ones that are buying into this market, and the market keeps on going up. It's not you or I, because what do you and I think about the stock market? To me it's overvalued at 0. So that's just me. So you've got your central banks. Then you've got your institutions. Now when we start talking about institutions, these are the Goldman Sachs, these are the if you understand JP Morgan, you got JP Morgan, you got Chase Bank. Those are 2 separate companies. Right? They're 2 separate entities. So you have your investment banks. Now what an investment bank does is investment banks raise money for particular deals. They take companies public, right? So example, if you understand how an IPO works, they'll basically say, whoever the issuing bank is on an IPO, they'll say, hey, we're gonna give you X number of shares for free, but then you're gonna sell those to all your people, and then we're gonna take that to market at a much higher price, and you're gonna get a cut of that difference in taking our stock public and helping us raise money. When we sell to the private investor, then you can sell your stock off to them and you're going to make money doing that. Institutions are moving the market. They are literally the Wizard of Oz behind the curtain. They're the ones behind the scenes that are really kind of running the investment show. If you understand the way like CNBC and a lot of these places work, those are marketing companies for the stock market. So really what will happen is you'll see when you watch these analysts on TV, institutions will never tell you what they're buying, right? Anytime you ever watch a gold, anytime you see, buy gold, buy gold, buy gold, it's because they're looking to the retail side to sell to. So when we're talking about retail investments, this is different than what you and I are, clicking a computer screen. But retail investors are going to be the guys that deal with you in the public, the Merrill Lynch's, the investment advisors, all of those guys that are making the recommendations. That's going to be retail. So you can see where the differences are. Now they may work for the same firm. Now if you understand the way that these work, so you own a grocery store, right? Mm-hmm. You're a gas station. So if you've got a product, let's say you've got 10 stacks, 10 boxes of Frito-Lay chips in the back that they're going to expire next month. What are you going to do with those chips?
You're motivated to get rid of them before they expire, so you might put them on a promotion price.
Okay, so you put them on a promotional price, right? Discount.
Yeah.
Could you do marketing around that?
Yeah.
How would you market? How do you market? What are some different ways?
In our stores, anything you just put near the register just goes. Like if it's in the customer's face, they just impulse buy it.
Okay, so in their face. So like if you think about traditional marketing, what are some ways that marketers get in your face? What do they do? Direct sales or direct marketing, right? Internet, TV, radio. So what happens is all these institutions do the very same thing. If they've bought something and they look for something to sell to, are they going to be able to sell to other institutions? No, because they don't know the game. They go to the retail side. And that's where the big commissions come from. The big broker dealers will be like, hey, we're going to pay you what's called, you may have heard me use the term earlier, a rip. You get a kickback. You sell my product, I'm gonna give you a kickback. Now legally, this can range from anywhere from $1, I don't know what the limits are now, but I think it's $2.50. So if they're really motivated, they can say per share, I'm gonna pay you $2.50 in the back end to a stockbroker. And he's gonna go sell. So imagine you have a stockbroker, right? And he's got two investments. He's got one that's gonna pay him $1, and he's got one that's gonna pay him $2.50. Who do you think he's gonna call his Rolodex of friends first to get to sell stock to? Which one is he gonna go to? $2.50, right? He's got the same client he sells for $1,000. He's got car payments and Ferrari payments and kids' education, private school, so you can see how those guys work. So they're money motivated. They're commission motivated. They don't necessarily have a fiduciary responsibility. And the thing is maybe they're both biotech stocks. Maybe you're comparing two companies in the same sector of the market or same industry. Well, I think this one's a better investment for you because they make a higher rev. That's how these guys get paid on the retail side. But what'll happen is before your stockbroker ever calls you, says, hey, I got this great company, ABC Pharmaceuticals. Oh, you know what? I actually saw that analyst on CNBC 3 nights ago saying that ABC Pharmaceuticals was a great stock to buy. And then I saw it come across my news thing within my brokerage firm saying, oh, this is a great investment. I was actually thinking about that. I'm glad you called. I guess it's heaven sent. Happens all the time. It's what they do. And they actually have a term for you. It's called dumb money. You don't want to be educated? Don't be. We don't care. We'll take your money any day of the week. You don't want to learn what to do? It's like anything else, right? You deserve to lose if you don't want to learn the rules of engagement, how to play the game. That's the way they look at you, right? It's capitalism. So those that have knowledge really is key, is what they're doing. And then you do have a whole series of traders. Have you ever asked yourself why every major sporting center, tallest building in a city are all financial companies? Do you know how financial companies make their money? How they get paid? It's the craziest thing. It's the craziest thing. Most people, I've worked on the banking side with JP Morgan, and I've worked on the retail side, and I've dealt with investments. If you saw how much money they make off your money, it would just blow you away. The returns, some of the products are like 800-900% annually on your money because it's so levered. They're 43 times levered from the Fed. It's zero. Money's being printed right now for free. They're giving money away. Everybody's like, oh, this is the worst economy in the world. No, you just don't know how to tap into it because the government wants to give you money. That's why they're printing so much of it. So, but then you do have your active traders, those guys. A lot of them, institutions have them too. Guys that sit in their underwear and traders like Bright Trading's a trading desk. Two of the guys that I have with me on my firm right now, the guys that are trading are previous Bright traders. So they're very active. Bright Trading, really what they used to do is they had these big, huge floors. They would give you capital, or you could open an account with them and get you institutional rates. The floor would cost you $0.01 a share in New York and then $0.02 a share in NASDAQ. And you could just sit there and trade and make money all day long. So those are kind of the thing of the past now with the internet. You pretty much can trade anywhere. All right.